we'll be focusing primarily on foundations to institutional order flow and understanding liquidity. All right, so when we're considering what the large institutions are doing and how to operate and engage in the foreign exchange market, the premise I want to begin my trading with and my analysis with on the weekend is what I think the weekly chart's going to do. And that's what we're showing here. This is a weekly chart of the British pound versus US dollar. Every candle in this chart represents the highest and lowest price for an individual weekly range. And I sit down in my weekly chart and I look for areas that are obvious. Okay, what do I mean by obvious? Years ago I taught that if you find a level that's too clean, okay, and it's this too straight edge, chances are it's probably going to get swept. What do I mean by that? Well, if you look at this area right here, notice how this candle goes to that low, the body stops here, the body stops here. It doesn't really have any kind of jagged end or bottom to it. Just real smooth and clean. Just like this high and this high has a relatively clean level up there. And these two candles here have a really nice clean level to it. And these right here are pretty much the same thing. But my eye jumps to these levels. The significance about these levels is that below this level here is sell stops. Traders that went long here, they had stop loss orders to protect that long in the form of sell stops. So this level in here is saturated with willing participants that want to sell at the market, because their belief is if it goes below this level here, they're probably wrong in their long idea and they want to get out before it causes them to lose more money. Conversely, there are traders that will see this level as support, and if it breaks, their idea is, well, support's broken, so it's probably bearish, and they want to go short. So how do you go short? You sell. So the function of the liquidity that rests below these smooth or clean equal lows is sell side in nature. So it's sell stops or sell side liquidity. The market last week, at the time of this recording, it is July 27th, 2021. And the market trades down last week and sweeps below these clean candles. Okay, so this area here gets attacked. And notice it comes off that low and closes here on the week. The week at present of this recording, we opened here, had a small little movement below the opening of the week, and then we had this movement higher. Now, prior to this candle closing up here, we didn't really know if it's going to go down there and continue going lower or if it's going to reverse. That's not necessary. To find profitability in consistent setups, all we're looking for is runs on liquidity. Okay, so you have to know where the draw on liquidity is, and that's what I'm showing you here. This is what you're looking for. Areas that are too clean that may draw price up into them or down into them. So just the opposite of what we saw down here, what would be resting above these relative equal highs? Buy stops. Anyone that was short, how will a trader protect his bearish position? With a buy stop. So any movement above here, that would trigger buy stops on shorts, and or some traders that see this as resistance, if it breaks that, they would see it as what? Resistance broken, therefore bullish. So this is the closest draw on liquidity that's opposing this. So when we started the week here, we opened, traded down just a little bit, and started to trade higher. Where's it likely to go? Right above these highs. Doesn't mean it will absolutely do it, but this is what we do. We look for areas where the draw on liquidity acts like a magnet. Okay, imagine how this candle's gravitating towards this level here to attack and absorb the liquidity which rests in the form of buy stops, which is opposite of what we saw down here. So the buy stops here are the near-term draw on liquidity. So institutional order flow for the week should be bullish until we get up into this area. At that moment, we'd have to reassess everything, continuation if it's likely, or reversal if it's likely, or just consolidation. But we don't need to know that right now. That starts the week here with the likelihood of running up into this area. So the inability for price to make a significant price run lower is the tip-off that we're going to see institutional order flow or bias or trend or momentum to the upside until we get into this area right here for the purpose of attacking this buy side liquidity pool for the buy stops. So if we zoom in here, I want you to think about the weekly range in the context that the open and decline from the opening price anywhere in this area close to the opening price or below it is ideal for going long. This is the cheapest it's likely to get. And the closest you can buy around that opening price, the better. As we get closer and closer to this area up here, the idea of probability or low risk starts to dissipate because we have the likelihood that this could retrace back in this range. Now, at the time of this recording, it's only Tuesday evening in my local time on the East Coast of the United States, but it could very easily continue and trade well beyond these levels here into Wednesday and Thursday, maybe even Friday. I don't need to know that. The premise starts with, we're down here, we came off the low after taking stops. It's probably going to make a run for this area up here for liquidity. So the ideal scenario is if I'm thinking that, that means the weekly range is likely to be bullish, or at least I'm outlining it as that. So for my qualitative analysis, this is what I'm doing. Remember, in the first volume, we did quantitative analysis, where there were measures that were data-oriented. This is a little bit more subjective, so that's why it's qualitative. And the idea is if I'm bullish for the week, I'm expecting Monday and Tuesday and early parts of Wednesday to be bullish until we get to an area where the draw on liquidity is reached. We're going to drop down to a daily chart here. You can see Monday's trading. This is the candle for the entire range of trading on Monday, July 26th, 2021. And then Tuesday's trading daily range for July 27th, 2021. And notice how Monday we had a nice little rally higher. And on Tuesday we opened here. And then we traded down into this candle right there. This candle is what I teach as a bullish order block. The market's already bullish, or the underlying narrative is bullish, and we had a confirmation the market wants to go higher. On Monday, it trades higher. On Tuesday, we trade down into that level. The opening price hits it, trades off of that, rallies back through, and makes a higher high than that of on Monday. Remember, the candle opens here and then trades down. This is a Judas swing. Retail traders get caught up in that on the lower time frame. They think it's bearish and they start selling short. And then when it hits a higher time frame level like this, that's key or significant, it will reverse and start to trade higher, and it catches them off guard. Some of you have probably noticed that I posted a trade or a result of a trade that I did today in British pound versus US dollar. This very market. I'm showing you the framework and context because I knew I was teaching this today in the second volume of this teaching series. So I'm teaching you on the level of my YouTube content. And everyone's familiar with my concept of the order block through this YouTube channel. Using the bias that suggests that this is likely to reach up into these buy stops. So I'm anticipating its continuation into Wednesday to attack this. Now, does it need to do it? No, because I've already been profitable on the entry and management of Tuesday's trading. Dropping down to an hourly chart, that blue line I used on the daily chart to identify the bullish order block level is now green here. Okay, so I don't want to trip you up. I just want to have a contrast because of the time frame. This level is that same bullish order block level. On the daily, just transposed to the hourly chart. Notice how the hourly chart trades down, hits it, rebounds, and starts to trade higher. This is that area where the buy stops are. This level and higher is where those buy stops reside. So it's drawing price up there. Zooming in here, you can see again, this is the daily bullish order block level. And I want you to look closer. Think about what I was showing you on the weekly chart. Those clean levels, well, there's singular candle lows and highs, or swing point highs and swing point lows, or swing lows and swing highs, depending on how you want to say it. They have stops above and below those as well. This candle right here is a case in point. We have a swing low, a single candle that has a higher low to the right and a higher low to the left. One single candle there, that swing low, is going to be seen as a short-term swing low where sell stops are sitting right below that. Because the market's rallied up, it consolidated, rallied again, and when it's up in here, all in this consolidation, those that bought down here, or even over here, they have their stop loss trailed right below that low. And the market drops down to take those participants out and then rallies. Why is it going down there? To accumulate sell stops. Why are they attacking the sell stops? Because this is attacking participants that are willing to sell at a lower price. Lower than what? When it was up here. Institutional traders will not buy up here. They're going to wait for it to drop down to attack a very deep discounted price and pool of liquidity of sellers that want to sell at a cheap price because they trail their stop loss up there. So these sell stops flood the market with sell orders, and smart money buys them at the market. So it goes right in here and buys them. So this is called pairing of orders. The market hits this, and then price rallies. Now this is that same swing low, zoomed in, but I'm drawing your attention to these consecutive down close candles because this is a bullish order block, the high to the opening price. Now why not the entire range like a supply and demand zone would be? Well, this is not supply and demand. So it's the high down to the opening price, extend that out in time, and the market drops down into that. That's a bullish order block, and it's taking out sell stops. So a high probability order block is when it takes out stops and returns down to the order block itself. Not every down close candle is a bullish order block, and not every up close candle is a bearish order block. But if you are in a context that is bullish, as I've outlined here, and clearly proven, I was trading with this bias today, the underlying pinnings of the market is it's bullish, so therefore down close candles that have a market move away from it and has a swing low just above it, like we do here, that's a confluence of specific things that make it high probability for the order block. The order block is the consecutive down close candles. All three of them make up the order block. But the sensitive price point is the high and the opening. So you can be a buyer at this high or at the opening price. The easiest one is using the high and allowing your stop to absorb any adverse price movement against you that would, if it was going to go back into, say, the opening price, you have to consider that when you're placing your stop. So how does that affect your trade? Well, when you're starting out, without lowering any time frame beyond the 15-minute time frame here, you can be buying at the high and use the low of all the consecutive down close candles. Your stop loss needs to be just below that. Now you may look at this and say, oh no, that's too much of a stop. Well, that's all relative. In the beginning, it's good for you to try to trade like that because you don't want to be trying to be too precise, because many times the market will slice and dice you if you're trying to be too finicky about your entries and your stops. It can be very easy for the marketplace to take your 2-pip stop loss, 3-pip stop loss. It can do it, okay, because the broker has the right and freedom to do that, and they will. I'm not saying you can't use a very small, ultra tight stop loss, but doing it as consistently over and over and over again, the broker will just widen the spread and take you out, and there's nothing you can do about it. So, to repeat, a bullish order block that's high probability is when the market's already predisposed to go higher. It's shown a willingness to go higher and leave this area here, and we have a short-term low. So it has stops in a bullish market, and it trades down below that level here and into consecutive down close candles. So you would be buying at the high plus the spread, and your stop will be below this low right there. And that would be your underlying risk. Does the market stay there very long once it trades into it? No. Leaves it, consolidates, rallies again, comes back down into another order block here, trades lower, accumulates and rallies again, trades one more time, retracement, and then blasts off and attacks all the buy stops that were resting above these clean highs. Notice also, before the market starts to rally, it generally takes out some short-term swing low. This low took out this swing low. This low took out this swing low. This low took out this swing low. Each time there's a dynamic rally higher. This swing low was taken out by this swing low, and it rallies higher. This swing low is taken out by that swing low. Not by much, but it's all it takes. And then it starts to move higher. So when there's a run on liquidity that's opposed to the underlying direction, in other words, if we're bullish on a market like this, get comfortable with the market reaching underneath lows and stop thinking that it's going to be breaking down entirely or reversing. Most of the time, you're going to find that it's taking those sell stops out and absorbing them to offer smart money buying opportunities at deep discount prices. Finally, we're looking at price on Monday and today, Tuesday. And I want you to notice how the market does what? It creates the low in London, which is exactly what I teach on my YouTube channel, and then a continuation in the New York session. On Tuesday, it creates the low of the day, and a continuation in New York, and it rallies up. It's consolidating in here, and where does the liquidity reside? Again, this blue line is that weekly line I drew out that was a clean level where the buy stops are. So the market's most likely going to draw up into that 139 big figure, 139.10, and the institutional level 139.20 could potentially be traded to as well to make sure it really sweeps out all those buy stops. Now, what's the vested interest for the market to send price that high? Because smart money has bought down here, they bought down here, and they bought down here. Where do they want to get out at? At a high price. Who's willing to buy it from them at a high price? The buy stops resting just above that level here I noted on the weekly chart. So we covered several things in here. Foundations to institutional order flow. How do we frame that? We look for the weekly range. We look for clean levels. Very clean levels. Your eye needs to be trained to look for them. And the easiest way to do that is go through back logging and look at old historical price moves and mark them up on your chart. That historical study will train your eye and activate your reticular activating system. And that means when you see something over and over again, it makes you sensitive to it. So that way you will start to anticipate it when you see familiar patterns in live price action. And it makes you better at reading the tape. Reading the tape is just simply understanding what the market's doing live or what it's about to do next. Okay? So hopefully you found something in this that was helpful and insightful. And until I talk to you in the next installment. This is volume 3 of the Inner Circle Trader Market Maker series. In this volume, I'll be teaching on market structure, key levels, and SMT. All right, we're going to assume that when you're doing your qualitative analysis, that means we've already gone through all of the quantitative. We're assuming that the market price is up here, and your analysis suggests that there's a move likely to ensue that takes us down to a key level low. Now, these key level lows can be weekly lows, old highs of a higher time frame like 4-hour daily or monthly or weekly. They could be the top of an old trading range. There's multiple ideas that could be used for a key level, but what makes it a key level is it's on a monthly, weekly, daily, or 4-hour. Less importance and significance placed on the 4-hour, predominantly the higher time frame, daily, weekly, and monthly. Now, these levels are important. What makes them key is because they're used by large fund traders in their analysis. They're not really going into these 15-minute time frames, 1-hour charts, and things like that. Their analysis is predominantly linked and founded on the monthly, weekly, and daily time frames because the volume that they work in and out of the marketplace requires them to be trading on those time frames because they don't have the luxury like you and I to get in and trade on 1-minute charts, 5-minute charts, 15-minute intraday. So the idea is we're expecting where the market is now to trade down to this level, and then a reaction should ensue. Now, your choice as a trader is if we're here and you think it's going down here to set up a move to go later higher. You can be a trader from this point here down, or wait till it gets to this level and then try to trade the bounce. I'm going to leave that to you to decide because a mentor should not try to press everyone into a mold. It isn't a one mold fits all. It's a approach to understanding how price is delivered, and then you as a trader find a strategy or a process that allows you to engage price action without you feeling like you have to meet the same expectations that someone else is doing. So as the market trades down, inside this price swing, there's multiple opportunities in the form of swing trading, short-term trading, day trading, scalping, and you can trade on both sides of the marketplace. But predominantly, the larger position and or more risk can be assumed on the short side, whereas going long, maybe scalping, something like that, get counter trend to this expectation in the marketplace, you'll use a lot less leverage and try to be much more nimble. In other words, your objectives will be much more smaller than that of if you were trying to trade in line with this movement here. Once it trades to this level here, you would expect higher prices, and you can trade obviously with the majority of your leverage on the long side, and any scalping or short-term trades against this idea should be done so with very low leverage and very short-term price objectives. Now let this image burn in, so that way when we transition to the market maker buy model, it's this idea we have in mind here. Okay, market price is here, we're expecting it to trade down to a key level and then rally up. Now these lows can form two different ways. You can start by coming down, come off that short-term low, and then make a lower low, creating the ultimate low in this price swing here, and then price running higher. This sets up a ICT breaker where we have a low, high, lower low. Once it breaks that short-term high in the middle, if it trades back down into that, we could be a buyer somewhere over here to capture another continuation on the upside. Conversely, there is another formation you can see where it trades down, comes off the low, and turns with a higher low and starts to trade higher. This one here, I like to see this form only if there is a SMT divergence that would be in a market that's closely correlated to the one I'm looking at here for the analysis. And what do I mean by that? Well, let's assume that this is the euro dollar, and I expected euro dollar to trade from its market price down to a key low, and then trade higher. At this low, if I see euro making the low and then a higher low, at the same time, pound dollar is making a low and then a lower low, that's an SMT divergence. Okay, smart money technique or smart money tool. I never really settled on the letter T, what it would stand for. It was always interchangeably used as smart money technique or smart money tool. It's just simply a divergence between closely correlated assets or markets. What this indicates is there's a strong disparity between what the algorithm is pricing in for one currency versus another. The theory I operate under is all boats rise with the tide. And if we're expecting higher prices in euro, it goes without saying that we should reasonably expect pound dollar to rally as well, unless there's other factors that are outside the scope of this teaching that would negate that. But for the majority of the time, and a general rule of thumb, all foreign currencies should be rallying together and falling dollar seen with that instance. Here, if we have a higher low in euro and cable goes low, lower low, it's indicating that the algorithm is not wanting to take euro dollar to a lower low like it did with cable or British pound versus US dollar. And that crack in correlation many times signifies a timing aspect that would be confirmation to expecting this level down here being significant or key that leads to an upward price swing later. Okay, with that idea in mind, usually the market will be in some measure of consolidation. I like to see some kind of a little short-term trading range, and it is very subjective, this part. Okay, what is a trading range or a consolidation? Where price is having several candles, not two, not three, not four, but it just stays in an area over a prolonged period of time. How much time, Michael? It's all relative to the time frame you're looking at. If you're looking at a 15-minute time frame, it could be, I don't know, maybe 10 candles or more. And I'm just giving you a rough idea because experience is going to guide you on how many candles really make up a consolidation. Studying price, especially if you're a new student, this is going to seem too vague. And I had this complaint before when I was teaching on baby pips. As soon as I started to introduce an idea, right away they expect to have the understanding entirely from one lesson. And you have to have something of a comprehensive study approach to what I'm teaching because it's not simple, but it is simple once you understand all the moving parts. So from a modular standpoint, when I say that the market is usually in some kind of a short-term consolidation, it could be, consolidation on one time frame, but just simply 2 or 3 candles on another time frame that would be higher up. So it's all relative to what you're expecting in terms of the market price. If it's on a 5-minute chart, the consolidation may look a lot longer in terms of duration, versus if you look at it from a 4-hour chart, it's all within one candle and you don't even see a consolidation. But for the sake of continuity, let's just assume that we understand there's a short-term consolidation here. I'll be giving you an example here so that way you're not left with too much vagueness. So the market will leave this consolidation, and inside this decline, we wait for another area of either retracement back to the original consolidation, which it does not have to do. Okay, it does not need to do this. This is kind of like what the Wyckoff theory folks will look for. There's lots of times where it just doesn't do that. And that's why I don't teach Wyckoff. That's why what I'm teaching you here is not Wyckoff. So as the market drops down, I allow in my analysis the potential to return back to the original consolidation. But if it does, I need to see a very sharp rejection there. It can't just come back to the original consolidation low and then hang around for a little while. It needs to come back up there and then break. I like it even better if it tries to make an attempt to get back to the original consolidation low, okay, and fail to get there and then breaks hard. I really like that because that indicates a very heavy market and it's likely to continue going lower. But either or, the next short-term consolidation, and this doesn't usually last as long as the original consolidation up here. So what we're looking at is a consolidation, a market that breaks lower, that maybe trades up to here, and if it does, we'll look for a sharp decline. If it doesn't and just goes right into another area of consolidation, it usually will set up like an optimal trade entry, And if you're new to this channel or you're just watching this video for the first time, I have a plethora of videos that teaches my optimal trade entry pattern. It's a very simple little pattern. It repeats every single day. It repeats on every single time frame. You just need to know what you're looking for and why it should be forming there. And this is really the point of this lesson, is where in market structure should things occur and how do we interpret it and how do we anticipate it. So in this area here, usually you're going to see an optimal trade entry short. It'll be a low retracement back up into a bearish order block and then slams lower. Or it could be a low short-term high and then a higher short-term high that runs out short-term buy stops. Then it sells off. So either one of those instances will allow for me to take a trade going short. Because remember, I'm waiting for some level down here I've indicated at the beginning of this discussion that I think it's going to trade down to. Or I'm watching price and I'm not really engaging price. I'm just monitoring it and practicing and reading price. And I anticipate some measure of selling in this area. Or I'm watching price so that way it just keeps me closer to the marketplace. And I'm practicing either with a paper trade or a demo trade, or I'm illustrating something with my teachings and lessons. I'm just anticipating, whether I'm engaging or not, another price leg lower. And when it comes, should it come, we're waiting for some kind of expansion lower. And sometimes we'll get a secondary level of distribution, which will be another either optimal trade entry sell or a short-term high that's ran out with a higher short-term high, and then leads to another level of lower prices until we get into that area where we expect that key level to be reached. This is where the market goes into smart money reversal. Okay, usually it will form the same way it is outlined in the price swing, where it'll create a low, a lower low, and then look for a breaker, or it goes low, higher low. And if it occurs like that, again, using the intermarket relationships I mentioned earlier, if it creates a low with a higher low versus one definitive low that takes out a previous short-term low, in other words, the diagram I outlined when it was just that big blue V giving you a rough depiction of a price swing, the little animations I put in at the low, those are the only two things that can happen. That's it. So how they trade and form in price leads to what process you look for next. I'm not really interested in a market that will give me a dull, flat, blunt-ended low. I will avoid that. At all costs, I'll avoid that. Because that means I'm going to have to wait, because we could be seeing just another level of distribution that leads to another break lower. And then I'll revisit the analysis at a later time. But if we see price trade higher, we're going to assume that the smart money has accumulated longs in here. They are not pushing price up when they go long, by the way. We're seeing price trade down to this level, and then it kind of like spends a little bit of time down here, not a lot, certainly nowhere near the length of time that the original consolidation looks like. Very short-term little consolidation, and the algorithm keeps price in that range. Okay, so it's a small little dealing range it works in, and then it'll reprice. If smart money traders do not buy, they miss that move. So they'll have to wait for a low risk buy. And that usually will happen over here in a small little consolidation, which will form in what? In the form of a optimal trade entry buy, or a low and then a short-term lower low that takes out buy stops and then rallies. Remember I taught in the previous lesson in this series that usually right before significant price advances higher, some little short-term lows taken out for stop raids, and they assume those positions when the stops are taken. Those sell stops flood the market with selling, so that way counterparties that understand what the algorithm is about to do with price sending it higher, they'll buy those sell stops and they'll be positioned for a rally higher. We would expect price to trade higher until we get to another level of accumulation. So what we've already seen here is consolidating and accumulation of shorts. Accumulate more shorts. Accumulate more shorts. In this area, you may only get one area of distribution, and then it trades down to the smart money reversal, where they distribute their shorts down here. So they're going to buy to sellers at a low price, And everything they assumed over here should be hopefully offloaded here. Some of it here and some of it here. So their heavy positions are entered here. Some of it's taken off in profit here. Some of it's taken off in profit here and here. Or they'll go short here, add more here, and dump it all off here. So there's two ways for them to engage price and work within this market maker buy model. The longs that they assume here, they may not get them all on, and they'll have to add more here and then add more here, because as price is rallying up, it's going to be targeting the original consolidation until it targets the buy stops above this relative equal high or consolidation. All those buy stops will be the target of all of this. So if you're ever looking at price and you think that it's going to trade lower to go higher, the original consolidation, aim there. You might have a higher time frame target somewhere beyond that, but initially study all of old price data, price swings, and you'll see this phenomena is occurring. And you don't have to have all of the complications that are introduced with retail concepts. I mean, this might seem too vague and it may seem an oversimplistic approach to describing something, but I promise you, go into charts and study it, you'll see this very thing unfolding. It happens on all time frames, and it happens on buy and sell. This is a market maker buy model where they're taking price down, not the traders, the algorithm. All the algorithms are working together. It takes price down, then allows traders that know what to anticipate to onboard here. And then they take it in scalings here and here, and then finally the last bit of a run, it's in a hurry to get above here. And this is a complete market maker buy model. This is unique to me. This is something that I introduced years and years ago. And there's been some subtleties, people adding Wyckoff to it, trying to make it look like it's Wyckoff. It's not Wyckoff. It's very specific things. And elements that are over here have to agree with over here, and vice versa. And again, that's outside the scope of this teaching, but just know that there's logic that is very precise. It's extremely precision oriented, but this general idea here will serve you well as a roadmap for studying price swings. Now, conversely, we can look at price doing the opposite, where this is a ICT market maker sell model. We're going to assume that the market price is down here, and we think that the price is going to go up to some key high. Again, that could be running on an old high. It could be trading to an old high and just falling short of it because we don't think it's going to go higher. It could be trading back into an optimal trade entry sell. There's all kinds of things that would be outlining this as a key level. But what makes it key again is it's a monthly, weekly, or daily level, and at the lowest 4 hour. But again, I'm only throwing the 4 hour out there as just an extra side note, because predominantly the levels are going to be key because they're on those top higher time frame, daily, weekly, and monthly. So as the market trades higher and runs into that, you could be a participant in buying that up or studying it as it rallies up into that key level, and then the expectation of lower prices if it materializes. This whole fractal, or price swing, is what we're trying to strip down to its basic components. What elements occur inside this entire price range? That's what we're highlighting here with the models. The high can form obviously with the higher high and then breaking down, which sets up a potential bearish ICT breaker, which would be over here somewhere. But the high and then higher high forming this high, this is what I like to see. I'm more confident with this pattern. But conversely, if we're looking at it where we have a high and a failed higher high, and then it breaks here, this is only significant and a market structure break if we have intermarket relationship confirmation. Again, let's assume for a moment that this is British pound versus US dollar. And British pound versus US dollar makes a high and a short-term lower high and then breaks down. This is ideally a break in market structure on cable or pound dollar if euro dollar makes a high, low, higher high, and then it breaks down, because that would be a correlated pair SMT divergence, smart money technique or smart money tool. Because what that is indicating is that cable was underlyingly weak from an algorithmic standpoint. It was unable to make a higher high where euro was. And I'm speaking hypothetically, obviously, but that's how I would use this lower high formation. So in other words, if I think it's likely to form a lower high, then my attention will go to a correlated market. Like, again, if this is assuming pound dollar, I'm going to be really watching euro dollar, and I want to see, and if it's occurring here in cable, I want to see and almost demand that it's a higher high in euro. Now, if it creates a higher high in cable and it creates a higher high in euro, that means we might not be really topping yet, and I'll have to wait for more information or a real strong breakdown, and then I can get back in sync and trade with it later on, as you'll see. All right, again, the assumption is that we're at a market price down here. It could be trading in relatively cool lows or consolidation. Then it leaves the consolidation. At this point, again, the same, it could come back to the original consolidation high, but it doesn't have to. We're waiting for it to rally up into another area where it creates an optimal trade entry long, or it creates a short-term low and then another short-term low that's lower than it that takes out sell stops. And then we anticipate higher prices rallying higher until we get to another level of accumulation. So each one of these levels over here is accumulation. And another point of advancement on the upside until we get to our key level where we anticipate smart money reversal. Okay, so smart money reversal occurs with some measure of consolidation, not a lot, okay, but we're anticipating, expecting the algorithm to kind of like hold up there for a little while. What's a little while, Michael? Again, it's all relative to the time frame you're studying, because if this is a 5-minute chart, it's not going to spend 20 candles in a 5-minute interval up in this area. You know what I'm saying? Like it's going to be very short-lived. Whereas if we were on a 4-hour chart and we're seeing this pattern, and we're looking at a 5-minute chart, then it's going to probably look like a whole lot of candles. So it's all relative to what you're looking at through what time frame. And again, the way you learn how to do this and get better at reading what I'm suggesting here is you look at old data, the back testing and studying of old data. Every successful trader, every single one, whether they come through my camp or on their own or wherever else they went through it, they're always going to be better and versed because of their own study, the time they spend looking at old data and studying those price swings, because those things repeat. That element from rallying here up to some key level and then expecting it to trade lower, it will have all these elements to it. They might look slightly different each time, but they generally have the same repeating themes. After there's a smart money reversal, we expect price to trade and break lower until we get to another level over here where we would see another optimal trade entry sell. So it would be a low, a retracement back in, maybe to a bearish order block, and then a displacement lower until we get to another level of distribution. Now, in here, it could be the optimal trade entry sell, or it could be a short-term high and a higher short-term high, and then breakdown. Same thing here. It could be an optimal trade entry sell or a little retracement where it creates a short-term high, starts to go lower and runs up one more time, takes that out. And the question you're probably asking is, when does it do that? When will it do that in an optimal trade? Like, for instance, if you took a trade thinking it's an optimal trade entry sell here or here, how do you know that it's not going to be one of those trades where it takes out the short-term high that you went into going short and you get stopped out? That's going to happen. I can't promise that you're going to walk through this marketplace without having those cuts and scratches and bruises. You might break a bone or two. Okay, you're going to lose some money. But let's assume for a minute you're taking an optimal trade entry short here. And this goes for the same thing I just mentioned on the market maker buy model. This is the market maker sell model. Just reverse everything I'm saying here for the other one. If you take an optimal trade entry sell here, and it starts to go down and then runs up and takes you out of the trade, then what you can do is put a sell stop below the short-term low that's formed thus far. And if the market goes down there, it could take you right into the market short. And if it's going to do what we're expecting here, it probably isn't going to do a short-term high that's higher, and then a short-term high that's higher. That's unlikely. Can it happen? Yes. So rare, it's probably never going to happen, but it can. So there's no reason for you to fear being knocked out or kicked out of the marketplace and take a loss, because if your analysis is correct, then you're probably still going to capture some move and overcome that drawdown you've taken here. And if you get this other opportunity over here and you had a stop run here, chances are you're probably not going to get a stop run here. It'll probably just be the optimal trade entry run right from a bearish order block down. And it usually will be aggressive and quick to get down to the low of the original consolidation where sell stops are resting. So this is the elements to a market maker sell model. And again, for someone new, for someone that has not been looking at price charts for a long time, this is going to look too elementary, too simple, too vague, well, it's not really showing me anything. I'm not really grasping it. But I promise, if you go through your old charts and look at a price swing, say on a 4-hour chart that does basically something like this, and then you study it from a 15 or 5-minute chart, and you'll see this general idea. All right, so let's go over to the British pound. And if you've been following along in recent weeks, the discussion on pound dollar I gave you guys in this very series too. But let's take it back a little bit. Let's assume that we're looking at this level over here. It's a daily chart. It's relative equal lows, so you know what's resting below that, sell stops. And we're trading right here. So we're looking at this high, the low, and we retraced in, and we look like we're about to break lower. We have relative equal lows in here, so there's sell stops there. Lots of sell stops there. So we would expect to see price trade down there. So this is a key level. Ultimately, price does cascade lower. All of this here, my students in mentorship, we knew about this. We outlined this, talked about it before it happened. And the market has now, at this point, traded sell stops, accumulated longs, and then we have these relative equal highs. Okay, in the last lesson in this series, I talked about how this is the next draw on liquidity, and the market trades up into that on Thursday of the week of this production, and today's Friday. So the market trades up, and we've completed a accumulation of sell stops and a distribution to buy stops. Smart money buys sell stops and sells to buy stops. Okay, so we can use all of this information here for the weekly range to get to our objective on weekly PIP objectives. Let's assume this is that area where we were looking for the buy stops, and this is where the old low was on the daily chart where the sell stops were. Look what we have here. The market's consolidating. It leaves the consolidation, but why doesn't it come back up here? It doesn't need to. So it's better for it not to do that. And we have what? We have the level of distribution here, because we have what? Optimal trade entry, sells off. Another level here, optimal trade entry, sells off. Trades below that old relative equal low on the daily chart. That's that blue level on the daily chart. There's equal lows. Those sell stops are being absorbed here. The algorithm holds price in this little consolidation, allowing smart money to accumulate. Their buying does not send price up. That's not how this works, folks. I know you have books. I know you have authors and teachers and wannabe mentors that tell you that the buying sends price up like this. It does not. How many times have you seen people saying, oh yeah, we bought this, and I'm long, everybody's long. Everybody was long in Bitcoin before 20,000 back in several years ago. And I called the top on that. But everybody was buying, but it just still didn't send price higher. It went the other way because these markets are manipulated. They're controlled, folks. I know it doesn't feel good to hear that. It doesn't feel warm and fuzzy because it feels like, man, I really don't have a chance. No, in fact, you really do have a chance. If you understand how these markets are manipulated, you follow suit with what the algorithm will do. You're not going to always know. I don't always know. I know a lot. I know lots of times when it's going to do specific things. And I know when it's not likely to do the things that I would normally expect, and I avoid trading. But in this instance here, the market's consolidating, allowing smart money to accumulate longs. Once it takes off here, they can't enter. They've already missed that opportunity, so they're gonna have to wait for some new level of accumulation. We have a low, a high, optimal trade entry in here, rallies up. We have another level here. From this low to this low, that's optimal trade entry, because you have a high, low, higher low. Boom. Rally. Trades up, consolidates, rallies again, and then drops down, takes out that short-term low. We talked about this in the previous discussion, or volume. And then it accumulates and goes higher. The algorithm is driving price up here. It's not the buyers. Okay, it's not the buyers. The question is this. If it was just the buying pressure, why didn't it run from here all the way up to breakout above here? Because that's where we were aiming for. Why didn't it run from here right above here in one shot? Why is it doing all this consolidation? I mean, think about it. If the buyers are really controlling price, and then retail traders come in behind and they buy it later, chasing price, why doesn't all that translate into just singular price runs where it just goes in one shot? Because that's not how the markets book. Okay, it's not how it works, folks. All of these lows here are critical, as we'll talk about in later discussions that are outside this video. But nonetheless, we're looking at how price trades down into levels that take out short-term lows. Short-term lows were taken here, it rallies. Short-term low was here, it took it out, and then it rallies. Short-term low here, trades down below it, and then on FOMC right there, it wipes it out one more time and then rallies. Then it takes out this level here, which will be critical later in other videos in this series. And ultimately takes out all the buy stops above this relative equal high and or original consolidation. So this is a market maker buy model. This was what I hinged the analysis on in this video series live as we were walking through this week with you, and my mentorship students knew about this as well. The bias, why I was looking for what I was looking for, what I was expecting in cable, it's based on what I'm showing you here. Now, there's a lot more things that I'm teaching mentorship students that aren't going to be included in this series, obviously. And you can get upset and be mad, or you can say, you know what, I appreciate what you're showing me here. This is enough. You can make lots and lots of money with this. Okay, lots of it. You don't need a job. You can win FTMOs, and you can do all these funded account contests and get funded using what I'm teaching you on this YouTube channel. You do a review of what I'm referring to here as SMT divergence. On the right-hand side, it's the chart of the pound dollar, and the left-hand side, it's the dollar index. Here's that higher high in its own chart, and then here's that higher low on its independent chart on cable. So these two price points are correlated to these two price points. This should have went to a lower low than this one. It didn't. But because it didn't do that, and we're below those relative equal lows on the daily chart on cable, this was accumulation of longs. The algorithm is signaling to interbank traders that this is going to go higher. Not because of buying and selling pressure deficiencies, but because it's being controlled and manipulated. Don't take my word for it. I don't want you to believe me. I don't want you to believe me at all about what I'm showing you here. I want you to go into the charts and study it with this premise in mind. Go into it looking to disprove what I'm saying, and you're going to shock yourself because it's there. It's been there all this time. And until I started talking about it, no one paid any attention to it. So until we talk next time, be safe. All right, folks, welcome back. This is volume 4 of a continuing series of 5 parts on the Inner Circle Trader Market Maker series. I'm going to be teaching time and price theory. All right, keeping in sync with our present market conditions and what has transpired this week in pound dollar, no better way to learn how to do something than to apply it to a chart that's actually trading and you watch unfold this week. We have the hourly chart here on British pound versus US dollar, and with all the things that were mentioned covered in the previous volumes of this series, if you haven't watched obviously part 1, 2, and 3 of this series, then you should not be watching this video yet, because it's kind of requirement before you get to this. But the backdrop behind it is we've had S&P diversions down here. We've cleared out daily sell stops, so we've accumulated. We have a market maker buy model underway, and if that's what you're expecting and your analysis leads to a run above these relative equal highs and above the original consolidation here in the market maker buy model, let's incorporate the elements of time and price. So now I have the daily dividers on, and how I did this, in case you're wondering if you're new, all I did was create a vertical line and dropped it on the 0, 0 level on the time axis down here. That's going to be midnight New York time. If you have your time, it's important that you have your chart set to New York local time. That'll make understanding what I teach easy to follow along, because your charts will look like mine, and also you'll be looking at it through the lens of the algorithm. So New York midnight time is delineated each day. So we're looking at obviously today's trading and Friday, Thursday's trading, Wednesday's trading, Tuesday, and then finally Monday's trading of this week. Now when you're looking at this, go back and look at your notes, and we've outlined how this week of trading, July 26, 2021 to July 30th, 2021, was bullish for pound dollar. I made the case for it, why it was bullish. I pointed to where it was going to go, how it was going to trade there, and we have it here now in hindsight. So if you look at each individual day as 1/5 of the weekly range, each of these days have specific characteristics that are repeating in nature. Now, they're not always exactly the same each week, but what I'm going to teach you here, I've covered in other lessons in this YouTube channel. But for continuity's sake, and kind of like bring everything that you should have collected along your journey through all my videos here, we're looking at the delivery of the weekly range. And if we're bullish, the expectation is that there's a 70% chance that the low of the week is going to form on Monday, Tuesday, or by Wednesday's New York session. Now, right away, you're probably thinking, oh, that's a pretty wide envelope of time. You got a lot of ways to get it wrong. Well, consider what we have here. We have Monday's trading. We're already in a consolidation, and we left the consolidation. So is it likely to come back down and go below this low here when it's already taken out a low there? Remember what I've taught you so far in this series. Before price movements that are directionally driven, typically opposing stop losses will be taken, and then price will be allowed to deliver in your expected direction. In layman's terms, if you're bullish, look for swing lows to get traded below, and then it starts to move higher. Short-term low, trades below it, and then it starts to trade higher. Okay. Each day of this week was predominantly bullish until we get to Friday. Obviously, that ends the week. So if we look at a open, high, low, close perspective of the week, we see the week opening here. Small little movement lower, creating the low of the week on Monday. A retracement and a buying opportunity on Tuesday. A retracement and buying opportunity on Wednesday. And then Thursday, creating a short-term high of the week. And then Friday, we went just above the Thursday high, but not by much. And then we traded off the high, and we're probably going to close anywhere between 139.20 and 139 big figure. Okay, so going back to what I mentioned here and what I've taught in other lessons on this YouTube channel, is that we want to be buying on Monday, Tuesday, and at the best case scenario, if we missed buying opportunities on Monday and Tuesday, we want to try to buy on Wednesday in the New York session. Okay, but we'll talk more about other things that were factors this week as we go into the series in part 5. But for now, I want to bring in the opening price each day here at midnight. So we have this opening price here, extended out in time. How far is this going out? It's just showing till 10 a.m. You can take it out to 11 a.m., which basically is the heart of London close. So the idea is if you're bullish, you want to be buying at or below or very close to the opening price each day. We see it trade below the opening price and it rallies up. Day here opens and trades down all through London and then rallies higher on the day. Opening price here. We initially start to go higher, but then we trade down below it, and then we have another whipsaw below the low here on FOMC, and then trades higher. And then on Thursday, we're not incorporating the opening price on Thursday, and this is for your notes. Make sure you write this down. We're only looking for the influence of the opening price and buying below it or at it in a bullish expected week on Monday, Tuesday, and Wednesday. Thursday and Friday, they tend to create the opposite end of the weekly range. Okay, so try not to be looking to be a buyer on Thursday. Try not to be a buyer on Friday with the weekly range expectation. If you do that, you're going to miss trades, yes. But by far and large, you're going to protect yourself by avoiding being a buyer in a market move that's already been moving. Okay, obviously there's going to be days where it just continues on a Thursday and then Friday really explodes even higher. I've seen that happen in my own trading. I've missed pretty big moves on Friday. But I generally keep a small piece on, as I illustrated this week with trading the FOMC day. So I bought on this day, I bought on this day here. And I recorded and shared the FOMC trade and put it on my Telegram channel. You can see that, and left a small piece on it. It got me out at 139.50 on a limit. So you can design this any way you want. You can create a model where you get in on a Tuesday after you've seen Monday prove that it's wanting to go higher, and then it trades down below some short-term low, picks up the stops, and we have optimal trade entry here. And you can be a buyer there and basically allow Monday to trade without you. Or if you're hardcore and you're in consolidation like this and you think you are in a move where it's going to start to go higher rate from Monday's beginning of trading, then obviously you can put a small little position on there and then consider maybe taking a larger position once you have a better confirmation of the weekly range unfolding to the upside and a retracement down. As a new student or a new trader, when you see a day like this, and most of you probably have 1 and 5 minute charts up on your chart, you see this decline like that, it's heart stopping, especially if you don't have any experience. You're thinking, man, there's no way I could be a buyer of that. Well, we have relative equal highs. The bottom line is it's going down to pick up the sell stops. Flood the market with sell stops, allowing smart money to buy those sell stops. And then it takes off and goes higher. Each day of this week between Monday and Wednesday is offered a buying opportunity to get us above our target that was established for the weekly range, was trading above here for the buy stops. So let's strip this down and go a little bit closer. So we're zoomed in on an hourly chart. You can see here's Monday's trading, Tuesday's trading, sweeping below that short-term low there, and rallying. And we drop down here on FOMC Wednesday. It starts to come down and give us a buying opportunity here, but then on FOMC 2 o'clock in the afternoon New York time, the market whips down, knocking out traders that would have already trailed their stop loss right below that low. It gets tagged, and then it runs aggressively higher above that original consolidation, which is that red line here. So above that red line is our buy stops that we were aiming for, that I started teaching you about in the earlier parts of this series, in the earlier portion of the week. Then ultimately we trade, creating a short-term high on Thursday, slightly higher on Friday, and then profit-taking model kicks in, and you can see it returning back to that original consolidation. Study the relationship of the opening price at midnight in New York time and how buying below that opening price is ideal. This is where smart money accumulates longs. This is where smart money accumulates longs. and this is where smart money accumulates longs. They distribute their longs on Thursday and Friday if it offers higher prices. And then you expect price to come off that and trade back down into the range, which is the highest high formed intra-week to the low. And we're seeing that here. Now, if you look at it on a 15-minute time frame, I'm going to incorporate day of week and time of day. Here's that opening price at midnight. The market trades down, creating the low in London, rallies, comes back down in for an optimal trade entry. If you don't know what an optimal trade entry is, there is lots of videos on this YouTube channel that you can study and find out what that is. It's a really simple pattern, repeats all the time. So it creates an optimal trade entry right there. You can be a buyer there, and then trades back down again. We have a short-term low here and a short-term low here. And this low is during New York Open. So short-term low here to high, down in, and taking out a short-term low. What's occurring? They're taking out short-term stops right below here and optimal trade entry. Rallies in New York and continues higher. The next day, the market trades back down into the range that was established in the previous day. This right here is the reason why most of the time I'm leaving Monday's trading to everyone else. Because if I establish a long here and it starts to rally up, I may make the mistake of trailing my stop loss up to here, and then they take it on Tuesday, and then I got to go back in and reposition myself. So I want to study on Monday what they do, and then on Tuesday, generally that's my action day. And you can see there's a lot more animation in price on Tuesday, but look what they do. They drop it down into London, creating the low of the day, taking out this short-term low again the previous day. And if you look at the low to high, you're getting optimal trade entry there. The key is OTE, or optimal trade entry, is associated with time of day, a kill zone. These little hyphenated segments of annotation on the charts, London is delineated by 2 a.m. to 5 a.m. New York time. So again, if you're setting your time on TradingView to local New York time, always set it to that. No matter what location you are around the world, always look at TradingView through the lens of New York, period. If you do that, everything I teach you will make perfect sense. You won't be confused. But London kill zone is 2 o'clock in the morning to 5 a.m. New York is 7 a.m. to 10 a.m. And if you want to use the New York session time, not the New York kill zone, the New York session time is 8:30 in the morning to 11 a.m. New York time. But each turning point that occurs at these kill zones sets up a really nice run in price. See that little short-term low right there? It trades down below it and then takes off. So we're seeing this element of time, which is also associated with the day of the week, because day of the week is still an element of time. It's a calendar reference point to time. It's a block of time that we call Monday, Tuesday, Wednesday, and so forth. So the element of time and price is important because you need to focus and expect your analysis to be rooted on the first element, which is time. The markets will not generally give you setups that pan out between these two windows. There'll be a quiet little period, even though we have a nice run in here. Sometimes that will occur. Most of the time, it won't be like that. It'll be consolidation. And then after London close, you get these consolidations like this. This is like dead time. Again, same here, dead time. Same here, dead time. So we're looking to engage, if we're bullish, like we were teaching in this series, pound dollars bullish. Monday creates the low of the week. Tuesday creates a buying opportunity. New York on Wednesday, nice buying opportunity, but you have to have a wide stop. And if you get stopped out here, you can use obviously other approaches to getting involved with the marketplace with FOMC. But I'm going to teach you and remind you that you should not be trying to trade FOMC if you're a developing student, because it's too much of a whipsaw and you're going to get caught up with the short-term volatility, and you're going to be more paralyzed by fear, even with a demo account, and left confused than that of if you just simply study it from the sidelines and don't engage it at all. Okay? But the element of time is the first crucial factor to reading price. Price, when it gets to these levels that we look for below the opening price, okay, what price is important below the opening price? What time of day during London Open? These are buying opportunities here. This low, trading below this low, is a reference in terms of price. By itself, doesn't mean anything. Sometimes you can see a short-term low like this. We have these lows here, all three of them. 1, 2, 3. Look at this. We went down below it. So that's one of those times where ICT talks about, oh, this is when we went below the lows and expect price to blast off. No, because we're inside of a time window that's not important. It's not salient to the underlying bias because it's dead. It's a time when the algorithm is sitting still. It's going to just mark time is all it's doing, going sideways, just like it does here and like it does here. Okay, so the element of time is crucial because that's when the market will start to spool. That means the market will start unraveling in one direction or another, just start shooting off into a specific direction, aiming for a particular price. But when you're looking for price to behave a certain way, it needs to be inside of one of these kill zones for the highest probability. After London close each day, you should train yourself to anticipate consolidation, unless we get something like FOMC days, which is obviously, this is something that is not an every week instance. But you need to be looking at your economic calendar, because if you don't, you'll be caught off guard with these types of events, and you either want to be protecting yourself by not being in the marketplace or taking considerable amount of your position off ahead of it, so that way if it does reverse on you, you've paid yourself. But time is the first element. Keying up on Monday, Tuesday, or Wednesday for your trading. Now, if this was a bearish week, same thing, we'd be expecting a high to form on Monday, Tuesday, or Wednesday by New York session. But after Wednesday's New York session, probabilities start to fall off precipitously about catching shorts or trying to nail the high of the day when you're in bearish market environments. This week, we're going to stick with the narrative that we've outlined initially, is that this week was bullish. We've outlined why. I gave you examples on Telegram, and I showed you the fruits of it using this information. This little exclamation point is just highlighting the release of FOMC data. Okay, so this is 2 o'clock in the afternoon, New York time. Expect the volatility, and even though we had the run below these lows here and it started to rally up, this is classic FOMC. This is exactly what non-farm payroll does generally too. So if this was 8:30 in the morning on a Friday on non-farm payroll, this is what you would expect to see on non-farm payroll. If you're in an underlyingly bullish market, same scenario. So but I digress. So looking at this from the element of time and price, we know how to group an expectation and perception of analysis. When we look at time, we know there should be something occurring, but we have to anticipate that something, rooting it to the bias. What's the bias? Do we think the weekly range is going to be higher or lower? We don't care about that weekly closing price. I don't care where it's going to close. Where's the volatility going to send price? Mostly higher or mostly lower over the course of the days of this week? If I'm thinking bullish, I'm going to be focusing on Monday, Tuesday, and Wednesday, because I know the algorithm generally presents the really choice setups, if it's bullish, to be a buyer on Monday, Tuesday, and or Wednesday, but by Wednesday's New York session. Now, because Wednesday had a high volatility news driver with FOMC at 2 o'clock in the afternoon, that gives us a little bit more energy likely after 2 o'clock on FOMC's release. And we see that happen here. And it rolls over into Thursday's trading and so on. But knowing where you should be trying to buy, if you're bullish, you're trying to get below the opening price at midnight. That's threshold that makes your trade higher in probability. It doesn't guarantee profitability. It just means it's higher probability that you're buying a really cheap market. And you're buying it when smart money buys it. You're looking at prices that trade either to an optimal trade entry, to an order block, or runs out stops. If we're bullish, when you're trading your plan, okay, you have to have a plan, right? The plan is every time you create a short-term low, notice to see if it does a run below that while you're bullish inside of one of these kill zones. Relative equal lows, you see that? You trade down below that in London and below the opening price by itself, that's a buy. Now, you probably won't trust that because you want to have indicators, you want to have moving averages, you want to have all these other things that you put your faith in. All that faith that you established on retail logic and indicators and harmonic this and supply zone that, just reappropriate those faith tendencies on what I'm showing you here, because this is the truth. It's not about me, okay? It's not true because Michael says it. It's true because this is the truth. And I'm just the sounding board for it, okay? Once you understand this and you start studying it like this, you're going to see it's always been there. Always. But these 3 days and this element of time, that is crucial. And in what price? Where's the price factor in? Price is when you're taking out stops, returning to an order block, or an optimal trade entry. That's it. There's 3 little things there. Okay? 3 little things that you need to worry about. And not all 3 form at the same time. So you need not worry about, well, how do I know if it's going to do this and how do I know if it's going to do that? Well, look at, you have a low here forming, and then it trades down below it again. That might be what you're waiting for your model. You may not want to trade order blocks. You may not want to trade optimal trade entries. You just want to see a low and then wait and see if it runs below that low during London at a time when we're bullish on a Tuesday or Wednesday. And you could be a buyer there, expect price to rally up to 10 o'clock to noon, which is London close. And that's usually when it meets the opposite end of the daily range. Don't take my word for it. Go through your charts and study it. That's what the algorithm will generally try to do on Mondays, Tuesdays, and Wednesdays when the market is predominantly bullish for the week. Now, obviously, if there's an objective that we're looking for on the week and it hits it on Tuesday, okay, so we were bullish on Monday and Tuesday it rallies up. Say it went above that red line, which is that buy stop liquidity pool that I've outlined earlier in this series. And say it ran through that 20, 30 pips. That would mean we have the potential for the market to go into consolidation the rest of the week or have a deep retracement. Whereas we see on Tuesday, we didn't get to the high yet and sweep those stops yet. On Wednesday, we didn't get to it until here after FOMC. But did it do it convincingly above? No, it just went really lightly above, shallow run right there. And then later on in the day, when nobody's really paying attention, it starts to rally straight on up. So you got to factor the element of price for where you think price is going to reach for. So time and price theory. You're blending these things together to come up with a narrative that you want to follow. And you want to see if price is sticking to that narrative that you've outlined, or scenario, I guess it would be a better analogy. You're creating a scenario where you think, based on these times of the day and these days of the week, and the logic that this market's likely to go higher, to where that weekly buy stop liquidity pool I've outlined in this series that we've been harping on every time we've had a video. We're watching how all these things come together to give us a narrative that is delivering in price. And nothing here is random. It's exactly how it should be. If it's bullish, when should it create a low to go higher? In one of these, if not all of them, London and New York kill zones. Just look at the chart right here. These windows of time, I taught this over 10 years ago. For free, right on baby pips, taught it. And they still work today. They were working before I taught it. They're going to keep working. Okay? The reason why is because the flows that come in at that time of the day creates the opportunity for the algorithm to move around. The flows or buying volume and selling volume is not moving price. The algorithm is operating on the time window. It knows the trading volume increases then. It's not a derivative of, okay, lots of buyers are coming in, so I'm going to start seeing price go higher because of that. No, that's not what it is. And I don't care who told you otherwise. It's not what's going on. These markets are absolutely manipulated, controlled, period. The state of a country's economy and the solvency of a central bank is not going to be put in the hands, okay, of Reddit. I mean, if everybody around the world said, hey, look, here's what we're going to do. We're all going to buy the British pound. And we're going to keep buying it no matter what. You really think that's going to be the catalyst for the British pound to go up and keep on going up no matter what? No way. But if you read social media today, that's what they want you to believe. That stocks are going to go to the moon because a handful of people on Reddit are buying it. That's not what these markets are doing, okay? These are the commodity. These are the products of a central bank. Their business is to control everything. Everything. And we as traders will never, absolutely never, ever, ever push price higher or lower because of buying and selling pressure. It's not going to happen. If they don't want it to go higher, it doesn't matter how many people buy it. It isn't going higher. That's it. So on the latter part of the week, you can see here on Wednesday's FOMC, we rolled into Thursday's trading. Nice little optimal trade entry here on London, sticking to the theme, and we ran up 80 pips above the 139 big figure. The 139.10 level is where that buy-side liquidity pool was basically linked to on the weekly chart. So we went 70 pips above that. That's a pretty good run. And here it is. We're on Thursday in the New York session, and then finally London close. Creates the high of the day, starts to drift lower, and then finally one more pump up in on London on Friday, running just a little bit above Thursday's high, and then we have a breakdown, and we'll look at that on a 5-minute chart. But we'll look at that when we get into the last part of the series. But each day has signatures that it follows, responds to in terms of time and price. It's not something that is random. It's fitting specific logic that has been taught in this YouTube channel. I can't take over 100 some different videos and compress it into one video and say, this is all the moving parts all at one time, but everything I'm showing you here has been amplified in other teachings, introduced obviously in teachings, and also shown by example. And now here it is again being shown to you where it's still working. We're going to take a closer look into lower time frames in the final volume on this series. Until then,
all right, folks,
be safe.
This is part 5 and the final installment for the Inner Circle Trader Market Maker series for the YouTube channel. I'm going to be teaching on daily bias and generic market macros. All right, so we've been teaching on the British pound versus US dollar in this series. It's relevant to the time of this recording. Those of you who are watching it as I'm producing it or looking at your charts, you'll be able to see all these things as well. But those that don't have that benefit and can't go back and look at 5-minute charts because some platforms don't let you do that, this will help fill in that little gap of education. Plus, I'll amplify some things on the lower time frames. So we're looking at Monday, July 26, 2021 on a 5-minute chart. Opening price at midnight. Price meandering around, trading down into London, taking out short-term low. As soon as that happens, you want to see, does it show a willingness to want to rally. It does. Then retraces back down again. It takes out a short-term low. Again, that would be an area where you could be a buyer. Rallies above. Now it takes out the initial high of the day during London Open kill zone. This right here is where retail traders like to buy that, and they have to suffer through all this retracement. You want to be buying below the opening price, or wait for a run above and then come back down into the open price. Now we have optimal trade entry there. Price shows displacement to the upside, creates relative equal highs before New York open kill zone, 7 a.m. New York local time. Market drops back down below a short-term low. Optimal trade entry from this low to high. OT is right there. You can pull that up on your own fib. Price runs the relative equal highs, trades into London close time period noon, shuts the door, high of the day is formed. All right, Tuesday of the same week. Remember, all of this is framed on the bullish weekly expectation to run into that buy-side liquidity pool. So the week's bullish. We already looked at Monday. Now here's Tuesday. Opening price here. We want to see it trade down first because it's a Judas swing. A Judas swing catches traders off guard. And they generally aren't looking at this as a buying opportunity. They're thinking it's going to keep going down. It goes down into the heart of London Open. So the low forming below a short-term low here. Rallies, short-term break there. So now we have optimal trade entry with a break in market structure in a bullish week and on Tuesday. Price starts to rally up. Trades right back to the opening price. Sells off once more. Rallies again and optimal trade entry. Rallies aggressively through the initial highs of the day. Again, London close time period between 10 o'clock in the morning and noon, New York time, creates the opposite end of the daily range. Goes a little bit higher later in the afternoon, but not by much. Try not to get so obsessed about getting the absolute highest high. And if you can capture a portion of this move here, who cares if you get out the actual high here or here? If you caught either the New York or the London, that's just a phenomenal trade. No matter how you slice it, that's what you're looking for. But this is how we're operating on an intraday basis inside a bullish market environment in a market that's shown a willingness to be bullish because of SMT below sell side liquidity pool in the daily chart. It's wanting to go higher. It's clearly reaching for some measure of buy stops. And we've outlined that on the weekly chart. And we're going to continuously look for buying opportunities until we get up to those buy stops. On Wednesday, July 28th, 2021, this is FOMC Wednesday. So we're seeing price back and forth. Every short-term high takes out a previous short-term high. Short-term low takes out a short-term low. High above this low gets taken out here, and we trade back up to here. So it's going back and forth, not letting any position stay safe. And then we go into a dive in New York, rallies up, and then closes the end of the day with London close. But FOMC is 2 o'clock in the afternoon. So we see it trade down again, taking out the short-term low, and then it rallies. This is seek and destroy. Okay, seek and destroy is a market profile where it's literally taking out short-term highs and lows all day long. Then finally at 2 o'clock in the afternoon, when the manipulation enters the marketplace, it takes out the low of the day. Why? Because I taught you before a market has a directional move that's strong in nature, that's really animated, bullish or bearish. If we're bullish, anticipate a low being taken. And you see what's happening here. You run down, the algorithm cleans that low out, then it goes higher. And you've seen me do the entry right in here, and you watched me take a trade and recorded it with TradingView with that idea after it took the low out, I felt confident trading it and attacking that buy side liquidity pool at 139.10. On Thursday, 29th of July, 2021, price had already started rallying in the afternoon of the previous day after FOMC announcement, and we had a little bit of a drop down on Thursday, but we're not going to reference the opening price on Thursday because we're so late in the week. We're focusing primarily on buying below the opening price in bullish weeks on Monday, Tuesday, and Wednesday. Bearish weeks, we're looking to sell short on Monday, Tuesday, and Wednesday above the opening price. On Thursdays and Fridays, we're not factoring that in. London, we have a price run here and trades back down into optimal trade entry. Rise again, consolidates a little bit. And in New York, we come very close to the high of the day, but London close creates the high of the day. Again, London closes 10 o'clock in the morning to noon, New York time. Then we fall off. Going into noon on Thursday, which brings us to the day of this recording, Friday, July 30th, 2021. This level here is Thursday's daily high, okay? So we have relative equal highs here and in previous day's high. We've been in a week that every day has gone higher. We've already been well above our objective, which is this level here for buy side liquidity, framed on that weekly chart. London, we trade down. Notice we were just a little ahead of the beginning at 2 o'clock in the morning. Trades a low there, retraces back down again here. Rallies, sweeps Thursday's high. Now, we have pressed every single day higher. Now we're on the last day of the week. The algorithm will likely trade back into the weekly range. When can we trust that? Well, we've swept Thursday's daily high. Go back, here's the low prior to that run. So we have this low and the highest high of the week. Market breaks down below that low right there. Then trades right back up into the last up close candle. Why is this a bearish order block? Because we've taken out previous day's high. We've worked the whole weekly range bullish every single day, and expectations will be a retracement back in the daily range. There's less likelihood of continuation on the upside this late in the week after it's gone so far above our objective, which was down here. So here we have a market structure break there, rally back up into bearish order block, which is another optimal trade entry. New York session, we see it break lower again. A strong break in New York there. Optimal trade entry, high, low, retracement. We have a low here and we have a low here, relative equal lows. It breaks down and attacks that old high and returns back to that area to consolidate. So all in all, we've watched how the algorithm will seek liquidity, take that liquidity. Once that liquidity has been taken, it will look for opposing liquidity. We saw how the daily chart on pound dollar traded lower to take out its relative equal lows, and below that was sell stops. So now, if they went down to take those sell stops and accumulate them as longs for smart money, where does smart money want to unload? Above this line here, that 139.10, which was the weekly buy stop liquidity pool. And we traded 80 plus pips above the 139 big figure. Cleaned out Thursday's high of the day forming, and then we break down. And all of this here is classic. This also, if you look at the consolidation here, this is original consolidation, accumulation, reaccumulation, smart money reversal. Where's the smart money reversal occurring? Above Thursday's high, which is the high of the week. Then we break down. Took out that low. This becomes a low risk sell. Distribution, redistribution, below the original consolidation, boom, market maker sell model. Where's it trade to? The old objective we had all week as a buy side liquidity pool. Everything fits together, folks. It may not feel like it right now. It may feel disjointed because you're just now starting to get serious about learning this. All these moving parts have their place in the grand scheme of things, in the great machine that is the algorithm. All these little pieces and components fit together. And once you understand it, it gives you clarity that is unrivaled. So hopefully you found everything in this series insightful, inspiring to try to get you into these other supportive lessons that's already been made available to you in the YouTube channel. Dig into them. Really take notes. It covers a lot of things on how to study, what you should be studying, what things you should be avoiding, times and days that look for specific things. I touched on a lot of that in this series. And literally, if you just followed this series, there's no reason why you can't carve out an income. Now, am I saying you're going to get rich? No, I can't say that. Can you make an income off of this? Absolutely, I believe you can. In fact, I have students all around the world that did not even join my mentorship. They've never seen a mentorship video. They have no idea what I'm teaching in there. They've only studied this content on the YouTube channel. They are independently making their own money without any insight from me, no hand holding. I'm not telling them what to do. They're doing it all on their own. And nothing can make me more proud than that. The fact that I've given you my time, I've shared my life's work with you all, and you've had the opportunity to test it for free. All you had to do is go into these videos and test it and see if what I was saying was true. Was it really in the charts like I said? And those diligent individuals all around the globe that put that challenge to the test, they discovered that this is in fact really what goes on. And some of them have went on to get funded, and now they're trading with the amount of money that they probably would have never been able to save up to do. And they're getting checks, they're getting payouts, they're getting inspiration every day because of the things that they're doing all by themselves. It has nothing to do with me. I don't want that credit. You're taking that risk. You pursued your passion. You believed in yourself learning this. And I should never be credited for your success there. That success, you earned it on your own. And those of you that are doing that, I'm so proud of you. I'm so proud of you. And I can't wait to see more success stories. Until next time, good luck and good trading. You can use all this information also to get in sync with what I teach in this YouTube channel, which is a one shot, one kill. This is the Wednesday FOMC day. And you can see this candle here. I went long. The fill was 138.65 and 2 pipettes. So as we dropped down, we swept this low, and then we went back down into it again. I trusted the fact that we didn't want to go back below that low, and I went long there. Rallied higher. I took a partial there, and I took a partial there. You see this in the recording on my Telegram channel. And then I also left 500,000 leverage on the trade with a limit order at 139.50. I took a partial there. 250,000 came off, and the final 250,000 came off on a limit basis at 139.51 and 1 pipette there. So this is a typical one shot, one kill, where I'm aiming for anywhere between 50 to 75 pips a week. And that's it. If I wouldn't have traded earlier in the week on Tuesday, this would have been enough by itself. But I did something on Tuesday with Pound, with my mentorship, and you all saw this one here. Using everything that I've outlined here from beginning to end, everything I used was literally YouTube level. It's not secret, mentorship stuff. Everything here is taught somewhere in my YouTube channel. Now, I get a lot of emails, and it takes forever for me to get through them. And it's gotten to the point where I'm probably never going to get caught up anytime soon. There's just so many of them coming in. But I can tell you that if you have the question in mind that where is a certain thing taught, I don't know specifically what videos, because I've done so many videos. I didn't keep a good record of what I did in each video. Years ago, some of my students were doing a really good job of documenting what's covered in what video and even what minute marker it would be. I don't know what that is. And maybe when you're doing your studies through this channel, when you study your videos, each time you come to a specific thing, you might want to break down the video and kind of like do it as chapters, like between minute marker this and this, ICT talked about this or that topic, or order blocks, or breakers or mitigation blocks, all those types of things. It'll make it easier for you to go back in and locate those areas to touch up on a subject matter that may be a sticking point or a struggling point for you. Obviously, there's a whole lot more to trading, and I could have took a lot more out of the free content here and made much more out of this series. But I literally watched the Market Maker series this week all over again, and I had a lot of talking in those videos. And while most of it's useful information, I want to kind of give you a rendition that was more to the point, that goes right to the heart of what all these videos should have given you an understanding, and then what should have been taken away. And this isn't everything. Like, I could have put even more into this, but I wanted to give you something that is useful, that I used in real world settings, where in front of lots of people, okay, all around the world. They watched me co-sign this whole idea this week, and it panned out, and it delivered like gangbusters. It's not a fluke. I could have talked about this and it could have flopped, but because it's rooted in the things I'm teaching you here, which was also taught in other areas of this YouTube channel, it's not created just because this stuff worked this week. Okay, it's literally every single week, these markets operate with these specific generic macros. A macro is a small little program that unfolds in an algorithm. And what they are is basically a price run from one level to the next during a specific time of day. Okay, that's the easiest one I can give you as an example. Another would be when it's bullish, a bullish optimal trade entry that forms between 7 o'clock in the morning and 10 o'clock in the morning New York time, and runs to 10:30 in the morning. Okay, that repeats a lot, several times a week. But I'm teaching you as my students to focus on the highest probable day of the week in the most probable direction, bullish or bearish, and the time of those specific days, and what those patterns of entry look like. There's other things, once you've gone through this series a couple times, taking copious notes, you want to go back into lessons where I talk about money management. I have psychology lessons in here, trade psychology. I have lessons on how to deal with drawdown, because you're going to have it. No matter how good you think you are, you're going to have drawdown. And how you're going to manage that, how you're going to overcome that, how you're going to mitigate those losing streaks. I teach that for free in this YouTube channel. I am convinced that everything I've given for free in this YouTube channel literally lays waste to everything out there you can buy as a course. And that's barring no mentor, none whatsoever. Because it's free, you can test drive it here. You can see right away if there's any fluff. There's a lot of talking, but the talking points are important because I'm actually addressing psychological factors that's going to either arise from the things that I'm telling you to do in the video, or from a previous video that I got feedback from. When I do a video, back then, when I was doing those videos, I was able to read my emails a little bit more quickly and keep up with it. Now, I just, with over 120,000 students, and I have YouTube channel audience too, I personally cannot keep up with the correspondence. I wish I could, because I love it. Sometimes it moves me to tears because of the joy I get by hearing these stories, and also the stories that people are struggling. Not every one of my students do exceedingly well. I'm going to be upfront and honest and tell you that. I've said it in the past. It's not like something I'm going to just confess to now. I've always said this. This is a very difficult business to do well in, because you're competing against yourself. You're misinformed. You're giving so much improper information. And there's so many people out there masquerading as someone that knows what they're doing. And all of that is a disadvantage for you. And it's almost like a landmine field laying in front of you. And you really need to know where to step. Because if you step the wrong place at the wrong time, it's over. And if you do it enough times, no matter how strong you feel about conquering this and knowing that there's going to be periods of adversity, at some point, even the best of you will want to throw in the towel and quit. I'm here to tell you, don't ever quit. It doesn't cost you anything to watch these videos except for the time that you invest. If you keep digging into them and keep practicing what I tell you to practice and keep studying and looking for the things I'm pointing to, it will happen for you. It will unlock your understanding, and one day, what day, I don't know, but it's always different for somebody else. And I have students from my 2016 group that still cannot make money. I'm being absolutely honest. But I also have students that just came in this final group in 2021 that are literally killing it because they were trading with information they learned here, but it was hit and miss, hit and miss. Now they're doing exceedingly well. Was it because they joined the mentorship? Probably. Or is it because they put enough time in beyond what they probably thought was going to be required? I think it's that. So don't give up. Don't let someone else convince you that you're wasting your time doing this. The worst thing you can do is tell your friends and your family what you're doing. Don't even do that because they're not going to understand. And they're going to be asking you, usually at the wrong times, hey, how you doing? You're so-and-so. And it'll be a period where you're struggling. And they'll be like, well, I'm glad I didn't listen to you. How's that going to make you feel? It's going to make you question whether or not what you're doing is a viable means of pursuit to a better life. When I'm telling you, it absolutely is. This is the last bastion, folks. Look around. I'm not going to describe what I'm really hinting at, but all you have to do is look around. Every form of employment is being ravaged right now. It's going to get worse. Do you have a hedge against that? Do you have a way for you to feed you and your family without having to leave your house or hold your hand out for a government handout? No subsidies required. No leaving your home. As long as you have an internet connection and equity in the account, you can eat. That's where we're at now. It's not about getting rich. It's about making sure that you can eat, that you can meet your bills, make your ends meet. So it's my prayer and heartfelt desire and passion to inspire you to do well. And hopefully I've given you some tools here to do that, or at least begin the journey and working towards it. You're always in my prayers. I'm always thinking about all of you. Even I don't know you. I've never laid my eyes on you face to face, never shook any of your hands. I'm rooting for you. And you'll get it. Just keep plugging. Until next time, be safe.